If you are holding a portfolio of consumer hardware stocks or traditional software companies today, you might be standing on the wrong side of the largest capital rotation in history. The market is currently telling us two very different stories. One is about infinite capital availability for artificial intelligence infrastructure. The other is about a brutal austerity hitting the consumer economy. We are going to map exactly how these two stories collide and why your safe assets might actually be your biggest risk. Nvidia was the first domino to fall this week. But the direction it fell wasn't just about chips. It was a signal that the consumer is no longer the customer. That shockwave is currently traveling through the supply chains of Dell and HP, and it is crashing into the valuation models of enterprise software. Then, we're going to look at the $12 trillion proposal sitting on a negotiating table in Europe that could completely reprice the energy and defense sectors by June. Stay with me and I will translate these headlines into margins and cash flow. Let's start with the most critical signal from the hardware sector. Nvidia has effectively decided to stop making new toys. The reports that Nvidia is skipping its next generation of consumer gaming graphics cards in 2026 are not a delay. They represent a permanent structural shift in capital allocation. For 30 years, the gaming market was the engine of graphics innovation. That era is over. When you look at the unit economics, it is simply math. An AI accelerator chip commands a gross margin of over 85%. A consumer gaming card struggles to hit 40%. In a world where manufacturing capacity is the scarcest resource, Nvidia is making a rational choice to abandon the low-margin consumer to chase the high-margin hyperscaler. This creates a massive vacuum in the market. And this is where the story gets dangerous for companies like Dell and HP. For the last decade, these hardware manufacturers relied on cheap, abundant memory chips to keep their prices down and their volumes up. That cheap supply is gone. With Micron Technology exiting its consumer-facing businesses to focus on enterprise AI memory, the spot market for standard components is drying up. We are seeing 80 to 90% price increases in component costs. Think about what that does to a company like Dell. They cannot pass a 30% price hike to a consumer who is already struggling with inflation. The demand just isn't there, but they cannot absorb that cost without destroying their earnings per share. This is what we call a margin crush. The result is that the middle class of hardware, the standard laptops, the gaming PCs, is going to see a period of stagflation. Prices go up, performance stays flat, and volumes collapse. If you are holding hardware OEMs thinking they are a value play, you need to check if they have any pricing power left. The evidence says they don't. Now let's follow the money to where it is actually going. The valuation of Anthropic has reached a breathtaking $350 billion in the secondary market. To put that in perspective, a startup with a fraction of the revenue of established players is now valued higher than Costco or Merck. But do not get distracted by the sticker price. Look at the product that is driving it. It is called Claude Cowork, an autonomous AI agent. This is the agentic shift, and it is a direct threat to the business model of almost every traditional software-as-a-service company in your portfolio. For 20 years, companies like Salesforce and Workday have sold software based on seats. You hire 1,000 employees, you buy 1,000 licenses. It was a beautiful model. But what happens when an AI agent can do the work of those junior analysts or data entry clerks? You don't hire the human. You don't buy the seat. If a company can replace 100 humans with 10 instances of an AI agent, the volume of software licenses sold crashes. The market is starting to realize that the terminal value of seat-based software revenue might be zero. We are moving to an outcome-based economy. You pay for the work done, not the tool used. This transition will be violent for legacy software companies that cannot pivot their pricing models fast enough. The $350 billion valuation for Anthropic is a bet that this transition happens faster than anyone expects. While the technology sector is bifurcating, the geopolitical landscape is being redrawn with a $12 trillion pen. We have reports of the Dmitriev package, a massive economic framework proposed by Russia involving $12 trillion in joint economic zones and reconstruction projects. This is coupled with a hard deadline from the United States for a ceasefire by June. This creates a binary event for the defense and energy sectors. The market has been pricing in a forever war scenario. Finally, we must map this terrain. Japan's liquidity changes, binary geopolitical events, and the AI supercycle mean the middle ground is where capital goes to die. Stick to extremes. Avoid the kill zone. Disclaimer. This is not financial advice. Do your own due diligence. Like and subscribe.